So, very good morning to all our viewers. We at Generational Capital are here once again to guide you all in this turbulent times. The markets have seen a great deal of correction in the last 3 to 4 months, as we can say. But now things are looking quite positive, and we have Satwik here, who's the founder of Generational Capital, multi-country investor with great experience investing across various verticals. So Satwik is here to guide us and help us to understand more about how the markets are going to be, what is going to be the outlook for towards the markets in the next 3 to 4 months, given the volatility that we have seen in the last few months. There has been a great talk about FII outflows, the dollar index kind of how it's been performing, the Trump tariffs that have been coming in. So even geopolitically, we are seeing that there have been a lot of turbulences and uncertainty that has been built up, and even the U.S. markets are now correcting. So it's been a I'd say a globally we've seen markets have been in a route, and I think this is where as Generational Capital, because we are a leading multifamily office having a long term mission to protect the funds, the purchasing power of our clients and increase its value over time. This is where we come in, and we try to take up the role of where how to guide them in these turbulent times, because these are the times which historically we have seen have led to great return and wealth flow in the next 4 to 6 months. So I'd like to bring Satvik on board here to kind of guide us and tell us more about how we should look towards the markets, and then as we go forward, we'll also focus on our AIF, the how it's been performing in the last 6 to 8 months, where we have seen some volatility, but of course, how Satvik goes about picking his stocks in the AIF, how the returns have been. So over to you, Satvik. Let's start with how the markets have been over the last 3 to 4 months. I mean, for someone who started in 2021 or 22, maybe it's one of the biggest corrections that they might have seen in this time. So, how would you guide people towards this?
Right. So I was going through some data points, and approximately 30 to 35% of the new demats which have been opened, so they have not seen a drawdown. Essentially, they have been opened up post-COVID. So this has been the first severe drawdown post the COVID has happened. So I collated some data points, and the normal questions we used to get is whether we should stop our systematic investment plan, whether we should stop investing in the markets, or how much should we invest, or we should time the markets. So this chart just shows that across cycles, right from 1996, when the markets had fallen 21% in a matter of around 3 months, to the 97 to 98 period, in around 15 months the markets had fallen 37%. Feb to in 2000, in 19 months markets had fallen around 54%. So broadly, the difference of kind of waiting to time the market versus consistently investing throughout, it does not make a serious difference. To give you some data points, so in the 96 period, the if someone had continued with the SIP throughout, the ups as well as downs, or if someone would have invested at the bottom, the returns would have broadly been around 14.5% IRR, right? Instead of what people think, that if they time the bottom, so the IRR would be a lot different, because it kind of neutralizes with the ups and downs of the market. Same way in the 97 to 98 period, because the drawdown were pretty severe, around 37%, the difference comes to around 30 basis points, but that's about it. So the whole idea is like it is only marginally higher for SIPs, the returns which have started at the bottom of the market cycle. And the cost of delay of SIP, by SIP I mean regular investments in the market, not necessarily the SIPs, can be huge over the long term. So now coming to how, again, these have been various questions asked by various investors across the country, as to there has been severe FII outflow. But again, we try to get into the data that it has to be looked as a percentage of the market cap, rather than in the absolute terms, because the market capitalization, the size of the GDP has also increased over a period of time. So, just to give you some perspective, while absolute FI outflows have reached record levels, uh, for example, around 34.9 billion during the geopolitical worries of 21 to 22, the impact on the market cap has been very less, and it's not like a very severe correction. So the broad conclusion here is, while we see FIs as a FI outflow as a negative indicator, the true impact must be analyzed in the context of the percentage of outflow as a market cap, and the various historical data, right from the global financial crisis to the US credit downgrade to the Fed hikes. It suggests that the FI exits are typically followed by strong recoveries. And broadly, these kind of money flows are kind of very tough, or I would say impossible to time. So it is best to be identifying good funds and good businesses and staying invested with them over the long term. Now, one more counter force to the foreign institutional investment is the domestic institutional investors, which would mostly be the mutual funds as well as portfolio management services as and AIS. So broadly, actively managed mutual funds manage around 1.64 lakh crore, and the current cash levels come to approximately 5 odd percent, and the balance fund manage around 1 lakh crores, where equity is only around 54%, which can go up to 80% in case of aggressive hybrid funds. Right, so and the monthly SIP book also is of broadly 25 odd thousand crore, which is continuously increasing. And the difference right now versus what was there in the previous kind of market cycle was, now people look at equities as a long-term asset allocation rather than just making money over 3 6 months and exiting. Then we had collated some long-term charts of the Nifty Sensex, and we were trying to have a method to the madness. Basically, history teaches us that patience rewards those who stay invested in the market. And broadly, if we miss the best, 1% of the days, so our returns kind of half in an XIRR basis, and deep corrections are followed by very strong recoveries, and normally we the index makes the index return mirror what the nominal GDP will be doing. So in the 2000 to 2003 dot-com bust, the turn of the millennium brought euphoria as the technology stocks surged, where multiple companies were being valued on the basis of eyeballs in the USA. In India, also multiple companies became 100x, 1000x without supporting fundamentals. But by 2000, the bubble kind of burst. Nifty fell around 53% from 1800 odd levels to 850. And 19 months it took to hit bottom, and around 46 months it took to reclaim its peak. But the investors who sold out in the panic missed that rally also, and then the mother of all bull runs, which was 2003 to 2007, where the Nifty itself went between 6 to 7x. Then very recent scenario of the COVID crash, where March 2020 was one of the scariest months in the history of the markets, where the Nifty fell by around 40% to 7,500 odd levels. But then the government intervened, businesses adopted, and recovery was very sharp. And within 10 months, the Nifty index hit all-time highs. Now, that is the futility of timing the markets, that on the day when the lockdown was announced, which was March 23, 2020, it was at that exact day that the Nifty made the bottom. Whereas the general consensus would be that now the lockdowns have started, things will get even worse. So the whole point is that we should be broadly invested in the markets, and markets are somewhat forward looking. And then March 2025, the month we are currently standing in. So over the past few months, Nifty has again corrected around 16 odd percent from its peak of around 26,000. history suggests, based on the last 20, 25, 30 years of data, that drawdowns are kind of temporary and could be lasting around 6 to 12 months. So it is anyone's guess when the markets will be hitting all-time highs, but as fund managers and as asset allocators, the best we can do is to identify good companies which are showing earning momentum and stay invested in them.
Right. So how do you outlook on in what is your outlook on India over the next 3 to 4 months? I mean, I understand 3 to 4 months is a very short period of time to tell us as a time frame. It's a shorter period. But what do you think where the market is going to head in terms of the companies that you have taken up, especially in your AIF? Let's talk about that now because we've already given a broader outlook where things have hit in a bottom and now things are looking up in the next. We've already seen in the last few weeks there have been some green shoots which we can say has been kind of a recovery in the markets. The markets have been looks like they have bottomed out, but obviously no one can call out the bottom. So
Right.
how do you look at the Indian India as a growth frontier? I mean, the is the growth story still alive? Because there were talks of stocks going up, valuations being too high, PE ratios of stocks hitting the roof. So what are your thoughts on India as a market right now to stay invested?
Right. So first, I'll kind of get to how our portfolio had performed in terms of the fundamentals over the last quarter, and then as to what the macroeconomic scenario looks like. Basically, in the Q3 FY25, which was kind of not one of the best economic scenarios, where the GDP growth rate was around 6%, falling from 7.5%, and the BSE 500 in terms of sales and profit grew by between the sales grew by around 9% and the profit grew by 13%. So our broad portfolio as a whole grew by around 33% in sales and 41% in profit. At that rate, the sales and profit kind of double every 15 to 18 months. And so broadly, the idea is to stick to the 25 cube framework which we have. That basically means we would be looking at companies which have a proven track record of growing at more than 20-25% in terms of sales, having zero debt or very less debt on their balance sheet, very high return on equity of 25% plus, and ideally available at 20 less than 25 time price to earning multiple. So if we get three out of these four, and then based on our research, the management is clean. They are willing to share what the company makes with the minority shareholders. So we think serious wealth can be made because there we get both the triggers of earnings growth also, basically earnings doubling every 2.5, 3 years, as well as the valuation re-rating scope will be there where the companies will be going from a 15-20 price to earning multiple to a 40-50 price to earning multiple. So broadly now coming to the framework. So first we'll try to identify sectors with consolidating profit pools. By sectors, I mean subsectors within the consumer healthcare and technology space, because these three sectors are where we focus more on. Once we have identified those companies to research on, broadly 200 to 250, we'll be running an in-depth forensic analysis and a fraud search on those companies, and then identifying what will be the moats of the businesses. Generally, we have seen that in India, execution is the biggest moat because the size of opportunity in most of the subsectors in these three major sectors will be at least 2000 3000 crores bare minimum. So the whole point is to take a call on whether the promoter can execute and he has that hunger to grow also. So in that parlance, we prefer to partner with or invest into first generation entrepreneurs, where the company growing will have a significant impact on their overall net worth. And then we finally identify 15 to 20, 25 companies which can be part of the portfolio. So this is broadly what the current portfolio looks like. Kind of into the green one shows the consumer basket, yellow shows the healthcare, and the blue shows the technology or IT services basket which we are having.
Right. So in terms of the sectors, I believe we majorly focusing on the consumption story. So Indian consumption story is still alive. And I think if you could also guide us on how volatile the portfolio has been in the last 3 to 4 months. So how do you think that is being managed in terms of the portfolio? How are you looking at things when there is huge volatility? Or we've seen that in sometimes in small caps and micro caps, liquidity can be a challenge. So how do you factor that in terms of your portfolio building?
Right. So the short answer to that is we have done nothing because we look at ourselves as part owners of businesses. Like this is what ultimately equity investing should be about, ideally. On the basis of volatility, basically we had again collated some data that the Nifty from its peak fell by around 15%. And from the 51 to 500 company, they fell by around 30%. Our portfolio from the peak till last month was broadly down by around 20 odd percent. And the beta of the portfolio has been around 0.65 compared to the BSE 500. So we have been very, very less volatile compared to the, you can say, the broader benchmarks, and significant alpha has been generated. Like approximately this financial year from April till today, we are up around 18 to 20%. With very less volatility, we have been able to manage pretty decent returns and significant alpha over the benchmarks. So, I would attribute that to how the businesses have been performing. Whereas the nominal GDP is growing at around 12 13% with 6 7% real GDP growth and 6 7% inflation. Our portfolio has been growing at 30% plus with almost 2 to 3 times return on equity or capital efficiency of what the top 50 or top 100 companies would be doing.
So are you still investing into portfolio companies where you see that the valuation has come down? So how are you deploying funds in terms of the cash level at the portfolio level? So how are you looking at your existing stocks, if I
Uh,
speak about it?
Basically, how we allocate new funds, especially in the alternate investment fund, is uh, the companies which are executing exceptionally well and the valuations we think are very, very reasonable. So there we will be adding to the stocks, and the companies which are reporting okay numbers or kind of meeting expectations. So there we would be staying put. So we would be increasing allocations to companies which would be doing outlier numbers and the valuations are reasonable, and with rest we'll be maintaining the weights.
Right, right. I heard you say about the AIF that we have somewhere around 18% returns in the last 1 year, whereas the benchmark has given, I think, single digit returns. So
Right.
what has been the key driver of these of this outperformance? So what in your view has been going right for the portfolio, and what do you think will continue in the next for anyone looking to invest in the next 2 months or 3 months who's looking to deploy? What would you guide them on how to go about it?
Well, frankly, say 9 months to 12 months is a very short time frame for the companies we are investing to the thesis to play out. But broadly, in this short time frame, what had worked was basically we were trying to buy companies at 10 times operating cash flow, to, 12 times, 15 times price to earnings, and in say around 2 to 4 companies, the discovery effect happens. So the idea is to buy into neglect where no one is looking into the companies and be one of the first few investors. Now, this does not necessarily mean a small cap or a micro cap company. Like around 4.5 years back, through the portfolio management service, also we had invested in Trent at around 15,000 crore market cap. So that time also very less coverage was there on the company, and they were kind of no like investors at large from the mutual funds PMS AIS space, because everyone was valuing it on a price to earning basis, whereas it had to be valued on a sum of the parts, and Zudio was scaling up well. So currently also we see a lot of opportunities in companies which are say even $1 billion market cap, growing very fast and very less institutional ownership.
Right, right. And I think with the Q4 results also coming out, we've seen that the India macro indicators have been good. The industrial output has risen, service index is has increased as compared to the last 2 to 3 months that the data that comes out, and even the inflation has come out down. So we've seen some triggers that RBI has also taken in terms of open market operations, trying to bring liquidity into the market. So do you think those factors are also going to help with the companies performing well, do you think the macro factors in India, that the economics is looking good, which will help the portfolio to kind of grow more in the next in the time to come?
Well, broadly, what had happened was around 6 to 8 months back, the RBI had tightened the whole liquidity. So the impact we were feeling from January, right? With RBI as well as SEBI, basically all the government bodies with the what had happened in the future and option market, they had tightened the market. The margin trading book had gone down. Now, gradually, money is being pumped back into the system. Along with that, there are some macroeconomic indicators also, like the PMI index has been doing very well. The tax collections have grown. If you look at right from corporate to personal tax, they have grown in double digits. So these are all healthy macroeconomic scenario. But frankly, Q4 I do not expect it to be a blockbuster quarter. But I'm pretty confident on the companies we own that at a portfolio level we should be growing at more than 30% plus.
Right, and I think that's what's going to be more important going forward, because if there's a small pool of companies that are growing at 30%, then eventually there will be a lot of funds, lot of investors who will be looking to buy into them, and with the flows going in, there is a high chance of them outperforming the broader market.
Right, right. So normally, the idea is to be there where very less kind of institutional ownership or analysis will be there, and be into leading brands or kind of quasi monopolies in those sectors. And so then, when the brokerage coverage starts, or you can say the institutional ownership starts, then we get the you can say the impact of the earning growth as well as the valuation re-rating or the discovery effect.
Right, right. So what is your average churn rate in the portfolio? Like, I believe that there is always going to be a long-term story behind micro cap and small cap investing. So overall, what has been the holding period in terms of the AIF that has been started? So can you guide that? That
So,
question came out from the
right,
audience.
right, right. So broadly, over the last 4.5 years across our various strategies, the churn rate has been broadly 20 odd percent. So
Right, which
it
is quite
translates.
low as compared to other small
Yeah,
cap funds. We've seen a high turnover rate. I think most funds have a turnover rate of almost 60-65%. So
right, right, right. So the average holding period of a company will be around 5 years, and the idea is to buy into businesses which are undervalued, not known by the street across small, mid, and large caps, and then hold them for a long time till the company keeps on executing or the valuations go pretty berserk. Basically, so I'll give you a couple of examples there also. Like there was this leading pharma company. So now that we have sold, we can openly discuss it by the name JB Pharma. So we had acquired, basically started investing in the company when the private equity group came into the business, and they bought in the whole Cadila management, and the CEO of Cadila had a super impressive track record of scaling up Cadilla's domestic business. The company was available at hardly 10 times operating cash flow, and historically it had been growing at around 17-18%. But with this aggressive management coming in, the company became the fastest growing domestic branded formulations company, and they grew 24-25% consistently for 3-4 years, and the valuations also re-rated, and the stock became 10x in that time frame. So that is kind of the ideal journey we would like to basically have with the companies we are associated with.
right. And I also see names like Safari Industries, Varun Beverages, Trend you already talked about. So what is your view on these companies, which were ideally, viewed as small cap companies, but now the market cap has gone up a huge time in the last 1 to 2 years we've seen. So ideally, these are not small cap by definition. So how do you talk about these companies in your portfolio?
Well, so now the definition of small cap. So right now, a 35,000 crore company will also be considered a small cap. So we look at patterns, which is basically solid track record of execution, the management basically hunger to scale up the business, as well as their willingness to share the profits with the minority shareholders. So if you look at the luggage industry, there are broadly three players only who are doing things at scale, which is VIP, Samsonite, and Safari. right? So Safari has clearly taken away market share over the last 3 year, 5 year, 10 year from the other two players, because they were focused on the mid-tier segment only, which is approximately 3 to 5 thousand per SKU kind of luggage, and they had other impressive offerings also, like no question asked replacement and very decent warranties also, and they scaled up very fast. Today, as we speak, I think they are the number two player in the industry, and they have consistently taken away market share from the other players, and they are having more than 23% of the overall luggage industry market. And still, they happen to be a small cap company, whereas they are kind of one of the leaders of the industry. Same way in terms of ethos, when we had analyzed them after they got listed, so the other players, so they were kind of having succession planning issues, or they were in severe debt, whereas Ethos was having very flawless execution. So from 20 stores, they went to around 55, 60 stores. Now the clear-cut vision is that in the next 2.5 to 3 years, they plan to go to 150 stores, and they break even also in a very, very fast time. And basically, they are associated with around 120 luxury watch brands like Rolex, Patek Philippe, uh, Jacob and Co. And if a 121st brand has to start retailing in India, most likely they would be starting to work with Ethos only. Right, and then the optionalities have been built in, like they have got into the luggage manufacturing, the luggage retailing with Remova, which is the most luxury brand in the whole world. In India, it was not there. They started their first store in Mumbai. They will be coming up in Delhi also. They have had exclusive licenses for Messica, which is again a luxury jewelry brand, and Bulgari also they have started retailing. So the optionalities are immense in these kind of companies.
Right. And also talking about debt. So how do you view debt in these portfolio companies? I understand that, I mean, it has been in the news that corporate debt is at an all-time low. And in the previous crisis that we have seen somewhere, there have been some bank defaults or huge, some trigger has been there. So how has the portfolio been safeguarded in terms of debt in your portfolio companies?
Right, right. So, ideally, at a portfolio level, we avoid debt. So we intend to invest only into mostly net debt-free companies, or at max there would be some sort of working capital debt. But broadly, if you talk about the macroeconomic scenario over the last 25 years, currently we are at the lowest corporate debt to GDP. If we talk about the top 500 or the top 5,000 companies, so the corporate balance sheet is very, very strong right now overall. And as far as our portfolio is considered, so we try to find the holy grail, whereas if things go wrong also, the companies have such strong balance sheets that they can survive an economic downturn also, into basically very secular sectors like consumer healthcare and technology.
Right. That makes sense, in fact, because I believe that the lack of debt in these companies is also signifying that there is a strong cash flow behind the business, which has also been leading to growth in terms of the portfolio, in terms of the profits. So it is not backed by debt-fueled growth, whereas it is backed by operational cash flows. So that also shows the strength of the portfolio in volatile times.
Right, right, absolutely correct.
So we're also taking some questions from our followers. So one question that comes in is, how do you look to exit from stocks? Like, what is a valuation that you think is expensive when we've seen that the stock has delivered good returns in the last, let's say, what is the target in your mind? Do you look at stocks that way as well in your portfolio?
No, I don't have any targets, because the thing is, if we are right, we make in multiples, not in percentages. And if we are wrong, then we are wrong. So the whole idea is to manage the risk. And so this is kind of an exercise what we do every quarter. So basically, how I analyze is, in every company, there will be a certain growth expectation built in, and the markets will basically either maintain the valuations at that level, or they will give them a higher valuation or a price to earning ratio if they maintain that growth rate. So the third column you see as an hit, miss, or expected, whereas whichever is in green, that means the company have either been as per what my expectations have been, what they have been built into the valuation, or they have surpassed that. So as long as the companies keep on doing this, we tend to hold on to companies, and once they stop growing as per expectations, then we plan to sell the companies. A couple of more factors are there. Suppose if the valuations go totally out of whack, suppose they are trading at obnoxious valuation based on their historical track record, or there is some competitive intensity coming in, like what happened in the paint sector or the cable and wire sector, then we will exit the companies. On the third part is if there is any serious corporate governance issues which come into the fray. So that is, even if the company we are holding is doing well, or we at cost we are at loss, we do not see, we will just exit the company.
So can you talk about some exits that have been taken in the portfolio in the last 6 to 8 months where you've seen or realized, and what would be the reason for exiting those stocks? Like
Uh,
cable sectors is one of the sectors I believe which has seen a lot of competition now coming in, and I believe
right.
you exited at the right time. So just
Right, right. So actually, that was, you can say, we thought there is some sort of corporate governance. So we were invested in the leading cable and wire company from its IPO over the last 4 5 years, and then some sort of corporate governance issue was coming in. So we thought it is wise to exit from the company and invest into other opportunities. Then we exited from this leading pharma company, JB Pharma, because they were trading at a 40 45 time price to earning multiple, and the growth was kind of tapering down because that base effect was coming in. So broadly, these are the kind of exits we would have done.
right, right. In terms of investors looking to deploy over the next 2 to 3 months, how would you position AIF or PMS as a product towards them? Is it the good time to invest, or should they look at a staggered approach to their to their investments?
Well, ideally, it should be looked at as a long-term asset allocation, and it should be done in a staggered way only, irrespective of where the markets are. Because frankly, we are not into that game of managing 3 month, 6 month, 9 month return. Because we want investors to have a long-term view and build gradual allocations on a month-on-month basis through one-time investments as well as SIPs, or when the markets are down and there are very good opportunities, then topping up more. Now, regarding what the difference between the two products, so we frankly prefer the alternate investment fund approach over the portfolio management service. A couple of reasons for that. One is a lot of companies will be coming up with their preferential allotments, pre-IPO anchor investments, as well as pre-IPO private placements. So and if we have done work on the company and we are planning to buy it post the IPO, and we are sure of managing the risks and the liquidity, so then it makes sense to participate in those companies before the IPO or through the preferential route. So, with that caveat, basically the AIF is a better suited vehicle compared to the PMS.
Right. So talking about pre-IPO opportunities, how do you look at them in terms of risk management, liquidity management? Because there is always going to be a big gestation period for the company between the IPO, which is pre-IPO to an IPO, which is also very crucial. So in terms of evaluating those companies, because they're not traded stocks as such.
Right,
So
right.
how do you look at entering those companies or investment opportunities in that sense, and how do you manage that risk
There I
in the
would like
AIO?
to make the distinction that we are not participating in pre-IPO, what is actively traded in the unlisted market. Like a lot of these, say, National Stock Exchange, HDB Financial Service, Tata Financial. So these kind of opportunities, we are not taking part. We are mostly interested in opportunities where we would be leading the round. By that I mean all the terms and conditions of that pre-IPO would be kind of set by us. So there, we have more kind of control on what the entry valuation will be. If things go south, the kind of exits we will be getting, those kind of things. So there, I think it makes more sense where we are leading the round. Suppose if it's a 100 rupee round, we are only putting in 50 rupees from our generational capital group.
Right. And I also believe FIs have also been bullish on the primary markets. I think they have invested somewhere around 1,20,000 odd crores in the last 1 year, although they have been net sellers in secondary markets. But there is some value in the primary markets also. That is why they have been putting in money. So that is one of the good ways, I think. that can be used to deliver alpha in the portfolio.
Right, right. And mostly these companies would again be undiscovered also. So when the discovery effect kicks in, the companies would be growing from a 10 time P ratio to a 30 time P ratio with the earning compounding going on. Like recently, right now also the transaction is going on. So I would refrain from taking the name. So it's a leading dairy company. They have the highest margins and highest return on capital like they have 36% return on capital employed. The next best player has around 25. The highest EBITDA margins of 12.5%. In the overall dairy industry, the next best player has 11%. And they are offering shares at around 9 time price to earning ratio. So like those kind of opportunities look very very attractive.
Right. And in terms of the risk metrics of the portfolio, can you show us about overall on a portfolio level, what is the risk in the AIF right now? The the alpha and the beta, how is that looking at
Right,
overall?
right. So I'll just take out that slide once. Yeah, so broadly, if you see, this is the chart we had kind of collated to see and analyze ourselves also, like what has been the alpha over the Nifty, what contributed to it, the correlation with the market. So broadly, the portfolio had been very, very less correlated to the market at around zero point 0.4. The beta was around 0.58. Significant alpha and the beta adjusted alpha also, which is taking into consideration against the volatility and the risk we are taking. So all the ratios looked pretty good, and again I would attribute it to the kind of stock selection we are focusing on, which is focused on the anti-fragile growth, that irrespective of the macros, at a portfolio level we should be targeting a 25% plus growth and entering the companies at very reasonable valuations.
Right. So going forward, you expect to maintain the risk at this level, or with companies, pre-IPO companies coming into the fray, do you think that somewhere this metric will not be a good indicator for the portfolio?
The pre-IPO will at maximum be kind of 10-12% of the portfolio. There also, like we are at least we are sure that the liquidity event will happen over the next 9 to 12 months. Because the companies would have been filing their DRHP when we would be investing in the companies. But broadly, again, like these risk metrics would be kind of an outcome rather than an input I would be taking. And even the stock selected would be an outcome on the. So I would always try to focus on the process because that is what I think will be repeatable over a very long term, rather than these metrics, which are kind of an outcome.
Right, right. And overall, in terms of liquidity coming into these stocks, what is your outlook, or what has been your learnings over the last correction? Like, how do you look at the current stocks in the portfolio? Has this correction made you change some thought process about the cause that you have taken?
No, nothing has changed as such. It's just that we are adding to the current set of stocks only because as long as the companies are doing well, we intend to add to the same set of businesses only.
Right. There is one question which says any calls that have gone wrong. What were the learnings? So,
In fact, multiple calls have gone wrong. Like, even if I get a 50-60% hit rate, it is like very good. So, broadly, in my case, where we go wrong is we have factored in a certain set of growth expectations as though, and those do not materialize. Like in this leading jewelry company based out of East, also, we had entered the company at around 8 times EV to EBITDA, and we were factoring it an 18 to 20% growth. The company went to around kind of a 12, 13 times EV EBITDA, but then the growth only stopped. So the stock price fell. So those kind of things happen, and a visual effects company where we thought the industry was very, very attractive. It was where the Indian IT was in the early 90s, and the whole industry was growing at 20% plus. But then the Hollywood writers' strike happened, and the whole industry went through a downturn, and the valuations fell through the cliff. So, those kind of things will keep on happening, and I think, and I was reading about. Like many large investors, like even Mr. George Soros, so he had a 37% hit rate when Warren Buffett would be having a 55, 60% hit rate. So the idea is to cut the losses where we are wrong, and make very decent money in multiples where we are right.
Right. So do you also look at alternative exposures in the portfolio, like let's say gold ETF or international markets, something like that to diversify the risks?
No, no. So we are like focused on the equity businesses only, and I think there only we can diversify decent risk, because we would be investing across subsectors, like right from watch retail to footwear retail to electronic retail to clothing retail, artificial jewelry, no, normal high-end gold jewelry, dental e-commerce, drone e-commerce. So we are diversifying the portfolio and making sure that broadly no two companies have the same set of risk exposures. So I would like to diversify it that way.
Right. And any sectors that you look to avoid or on which you are negative in terms of putting investments or in terms of entering sectors where you think that, like, do you avoid sectors as a whole?
So broadly, these three sectors, which is consumer, healthcare, technology, it is again an outcome because we have studied the last 140 years of Dow Jones data and had broadly seen that across down markets, Great Recession, Great Depression also, these three sectors kind of maintained their return on equity and did not go out of business. So we would generally avoid very capex heavy industries, any real estate, like large real estate plays, land bank plays, like a lot of investors were invested in couple of Mumbai based companies that they have these thousands of crores worth of land, and once they get acquired the value will be realized, but the land also got acquired at pennies to the pound. Anything and everything to do with the government we will like to avoid. Like we kind of were happy to miss the whole PSU rally, because like I strongly believe that the job of government is socialist in nature, and a capitalist will make much more money if they are focused on like running their business.
Another question coming from the audience is, can you give us the process on picking a stock where you've seen the growth, like right from the analysis stage to the investment stage? Any one of the few stocks where you have analyzed it right from the beginning? How has been the whole life cycle?
Right. So I'll just try to open up my slide. Yeah, so basically, this was a Bihar-based electronic retailer by the name Aditya Vision, which we had invested a few years back. So when we invested in the business, so in 2021, so then we analyzed that okay, over the last 5 years, 10 years, 15 years, the company had been consistently growing at 25% plus year on year. And they had been zero store closures since inception, which was very rare to find in retail industry and especially electronic retail. And the margins were kind of increasing, so we kind of the gross margins were kind of on an increasing trajectory. So then we kind of deep dive into them and found that basically the Hindi hinterland had very less electricity penetration till 2018, 19, 20, and now that was increasing. So for the first time, people were wanting to buy their TVs, washing machines, AC, so on and so forth. And ACs, washing machines were kind of 20% gross margin product versus what most of the other retails were selling, which was phones and these other products, which were 4, 5, 6% gross margin products. So the company was doing around 200 crore sales at that time, from around 25 stores, 25 to 30 stores. Come to 2025, the company has around 172 stores. They are doing more than 2000 crore of sales. Triple digit profitability. The stock price has also multiplied around 30x in that time frame, and this has been probably our largest winner till date. And
Right.
our pattern was the same, that we tried to enter at a single digit EV to EBITDA, which we believed to was a solid consumer franchisee, adopting a hub and spoke model in Bihar. Then it expanded from Bihar to Jharkhand, now to UP till Prayagraj.
Right. And how do you look at larger companies in the portfolio? Is the process still the same?
The process remains the same. See, the companies will be an outcome. Whether it is a large, mid, small, we will be following the process. Now, whichever company comes into the fray, now that is kind of immaterial. So again, Trent, I will like to take an example. So we had invested in the company at around 15,000 crore market cap in around 2019. So unlike most of the people were focusing on the price to earning ratio, we value Trent as a sum of the parts play. And we had frankly, we were very bullish on the west side part of the business. But Zudio scaled up from 200 crore turnover to 8,000 crore turnover. In those 5 years, Trend's sales grew by 5x, profits grew by 14x, with a return on invested capital exceeding 20%. This drove around 20x increase in its stock price, and making Trend one of our largest winners till date. Now, coming to the reverse part. So, the growth which was factored in Trend over the last year was around 45-50%. But a couple of quarters back, Trend started growing at 40%, then 35%. So then to manage our risk, we trimmed down the position to half also. So in these high growth companies, it is important to manage the risk also and be very sure as to what growth is factored in, and at the slight miss in growth also. So kind of looking to exit or trim the allocations also.
Right, right. That makes sense to track companies on a regular basis because growth-based investing has to be backed by strong fundamentals. So I believe that is one of the key points in the portfolio in the AIF that we have been managing very well. And one question that's coming in is if someone has, let's say, a one CR or a crore to invest right now, should they deploy it completely or do they deploy it in a percentage and rest through the SIP route? Like, what would you advise?
Well, ideally, around 50-60% should be deployed and rest through an SIP route. Like this would be my suggestion.
Right. And in terms of the AIF, like we've already gone through the portfolio companies, the investment approach. What are the current terms? Like what is the fund life, and in terms of exit loads, how is the AIF structured in that way?
It is so it was started exactly 1 year back. It was a 5 year plus one year fund, making it a 7 year fund at the longest. As such, there is no exit load or lock in. Because most of the families who have invested in the fund would be through our friends and family only, or they would have become that way. So we do not intend to charge anyone exit load as such, and basically make them long-term investors through on the basis of performance and communication.
Right, right. And another question is coming out on the weightage of various stocks. So I believe because you have a portfolio of around 25 stocks, somewhere around that stock. So how do you decide to give how much weightage to each stock, especially when one of the major stocks starts giving significant growth? So how do you look at that?
Right, right. Basically, we have this again framework of 3-5-7%, whereas this 2.5 to 3% allocation will be to the smaller companies, where we think that if we go right and the company executes, they can be serious wealth creation in multiples. But we want to manage the risk also. 5% allocation would be to companies like say Safari Industries, Ethos Watches, red tape, which would be kind of discovered, but the earnings momentum is very, very strong, and they would be very liquid also. Then 7% allocation would be to companies like Varun Beverages, where we are cognizant that the valuations are high. We might not make the highest returns, but they are for the safety part of the portfolio.
Right. And how do you regularly track the performance of these companies? Some of these companies may not hold regular con calls. So are you in touch with the promoters, or tracking the business? So how do you go about that every quarter?
Like most of the companies would be reporting quarterly results. Apart from that, then we do our own channel checks also from their peers also, and then have one-on-one calls with the management also. As it is now, nowadays everything is uploaded on the exchanges. So whenever we are also meeting any company, it gets uploaded on the exchange also. So in fact, if you see the last 14 days filing also, we would have met at least five of our portfolio companies.
Right. Right. And in terms of, let's say, the impact of geopolitical events like Trump tariffs, there has been a lot of talk about that. So, are these companies, because I believe that there is an Indian consumer sector that you focus on, or healthcare sector that is primarily domestic in terms of these
Right.
companies. So, what is going to be, do you think the
Broadly,
geopolitical impacts will have a big impact?
right. So broadly, 55 to 60% of the Indian GDP is being driven by the Indian domestic consumer. So we strongly believe, right, in the consumer segment, healthcare segment, even the technology segment, most of the our companies would be having, if not full, but broadly 80 to 90% domestic exposure only. Because the export variables are very, very tough to kind of navigate, including the currency depreciation and whatnot will be happening. The second thing is we have only one IT services company in the portfolio. That also is mostly India based. Very less revenue it has from USA. And apart from that, like they have most of their revenues from Africa. But broad thesis would be we like companies which are mostly domestic based. So that is why all these tariffs and all, I think, as a business level, they would be not affecting our companies.
Right, right. And there is also one more question coming out in a comparison between AIF and a mutual fund. What would you prefer overall, like in terms of the overall structure for an investor?
Uh, I would put it this way. A mutual fund is a very regulated and it's a saving product. It's a savings based product where basically it is very heavily monitored by, say, the government regulatory bodies. So the fund manager will be having very less kind of how do I put it? Basically, if it's a flexi cap fund, they have to select from the 500 stocks only. If it's a large cap fund, they have to select from the 100 stocks only. So the fund manager, I would think so, will not be able to utilize his best skills. Whereas in an alternate investment fund, it is an alpha generating product. So we can broadly do what a mutual fund is doing, but we can also, based on our skill set or where we have very high conviction, go out of the way also
Right, right.
to
And
invest in unique
one more
companies
question.
and get in before the mutual funds get in.
Right, right. I believe that is the way markets will out. That is way how outperformance can be done going forward.
Right, right.
Because in terms of mutual funds, if we pick few mutual funds, most of them have similar kind of stocks, and there's not a major differentiation, which is why the returns have been quite similar. One more question coming in is in again, it's about returns. Like, what would you guide your prospective investors in terms of the next few years in from returns from the AIF
Well,
overall?
broadly, I guide on the fundamentals that if the nominal GDP is growing at 12 to 14%, we are very confident that we can identify companies which can double in 3 years with a scope for valuation re-rating. So broadly, by that logic, like we should be doing significant alpha over any benchmark we take. So on the business wise, we are very confident that they will grow at 25% plus, which is doubling in 3 years, around 9.6 x in 10 years. Now, what whether they get a valuation re-rating or a de-rating, now that is anyone's guess.
Right. And there is one more question. I believe we are running out of time, but I'll still take few questions. One more coming in is, do you hedge the portfolio with short selling if required in the AIF?
No, so we are allowed and we have taken the mandate also, but I do not do that because the point is by short selling you can only make 100%, right? If you are wrong, stock will go to zero. If you're right, a stock will go to zero. But in the long side, basically, we are trying to find outliers which can make significant returns. So there, the upside can be 500%, 1000%, and all also. And then on short selling, there will be margin involved, derivative involved. So I try to avoid that.
Right. And any emerging sectors or unexplored sectors that are now that can be of your interest, or thoughts on companies like Oyo or Zepto, which may be going out for an IPO.
Frankly, this Ayurveda sector has been very, very interesting, and the companies have been showing very good results there. Frankly, I had not done a lot of deep dive on the sector, say around 3 years back, but over the last 3 years, based on whatever I have been researching, this sector is very, very underexplored, underinvested also by the investor community as a large, and there are exceptional companies in these sectors which are doing well. And now the sector, basically, now the government is also recognizing it. The sector is coming under the insurance penetration also. So I think the this sector, the Ayurveda sector, the natural healing wellness sector should do very, very well. Now it's important to back the right companies there, which are having exceptional track record of execution and the vision to make it big.
Right, right. So we are almost out of time now. One more last question that is coming in is, uh, like, what are the beaten down stocks in the portfolio? So any contrarian bets here? Like,
Well, basically, say our portfolio is right now also say 15 to 17% down from the peak it had achieved in October. So a lot of companies are at kind of beaten down names, but there also we are segregating that which company is doing exceptional growth. So we are allocating more towards those companies, like these couple of Ayurveda companies I told you about. There's this music streaming company, which I think is the best business model. In the overall unit economics parlance. So these kind of companies we are allocating more capital to.
right. And we've seen the broader market stocks are down by 50-60%. So
Right.
going down by 18-20% obviously is another kind of outperformance, we can say.
Right, right, yeah. And otherwise also, on a 1 year basis, we are up between 18 to 20%. So I think on a like-to-like basis versus the peers also and the other benchmark, there would be significant outperformance.
Right, right. So I think there are more questions coming in, but given the limited time that we have, I think we'll have to limit ourselves here. So thank you, Satwik. Thank you for shedding light on the portfolio on the AIF. As a conclusion, what would you like to say to potential and prospective investors who might be viewing the webinar right now? How would you advise them to look at the AIF as a diversifying product when compared to other modes of investment?
Well, broadly, the view should be that these companies would be exceptional companies which would be there in the alternate investment fund, which, say, if we were talking about 7, 8 years back, they would have not been broadly listed and would have been backed by, say, a Sequoia or a leading VC fund. But with the kind of the liquidity coming in the market, these companies have got listed. So we are trying to do high growth investing in the public market without taking any liquidity risk. So that would be the broad conclusion. And right now, there are very good opportunities available in the overall kind of business parlance, and where we especially look at less than one peg ratio, which is if the company is growing at 30% plus, it should be available at less than 30 times P. So there are multiple companies in that parlance. I think serious money should be made in those companies.
Right. So, coming to the conclusion, I think investors should not be hesitant to invest, given the recent correction. And if they maintain their investing discipline, the long-term story is still intact, and they will be getting good returns going forward.
Right, right, absolutely.
All right. So thank you, everyone. Thank you for joining in. It was great having you all here, and thank you, Satvik. It was great hosting you,
My
and
pleasure.
hopefully the markets will be doing well, and we'll have another session soon.
You.
Thank you.
Thank you.